Hey everyone, thank you so much. My name is Spencer Bogart. I'm with Blockchain Capital. We're one of the oldest venture firms dedicated to investing exclusively in the blockchain and crypto ecosystem. We're incredibly proud to have more than 70 companies in our portfolio today, many of which are the most well-known and most valuable companies in the space. And I'm incredibly honored to be on stage here with you today and to be included in CoinDesk's top 5 analysts of 2017. I think I ended up earning that just by making one call that was really, really right, and that was a long Bitcoin. So before I joined Blockchain Capital, I was doing traditional sell-side equity research covering software and internet companies like Salesforce and LinkedIn, and I started publishing research and price targets on Bitcoin. The first price target I put out was when Bitcoin was trading in the low 400s, and I put out a price target of 655. You should have seen the volume of emails and phone calls I received in the subsequent days, basically suggesting that I had lost the plot. But it's very vindicating to be on stage here with you today with 10,000 in sight and 655 way in the rear view. So enough with all that. I want to jump right in. How does my clicker work here? There we go. So I've got a lot I want to cover here and not a lot of time, so I'm going to move relatively quickly. The first thing is I want to go over some results from a survey that we recently conducted at Blockchain Capital that highlights kind of where we are as far as the crypto adoption cycle. The second thing I want to do is discuss how Bitcoin is a platypus. That should be fun. And then lastly, I want to talk about 3 components of Bitcoin's value. So first, a little background on the survey. This is a survey conducted by Harris Poll on behalf of Blockchain Capital. If you're not familiar, Harris Poll is the most reputable survey provider in the country. And I had to go through many iterations to make sure we eliminated bias and structured our questions appropriately, which is a good process to go through, but difficult. The idea was to gauge awareness, sentiment, ownership, and the propensity to purchase Bitcoin. The survey included more than 2,000 adults from across the country, and it was just conducted at the end of October, so all the results are very fresh and they're very relevant. Before we dive into some of the results, I'll give you the highlights. We can just do the good stuff up front here. So the first thing is that while people talk a lot about a Bitcoin bubble, a crypto bubble, we are at a batting practice, but we're only in the first inning of this game. And there's a long game ahead. And we'll see that throughout many of the results. The second thing is that as with many past major technology shifts, young people are leading the way here, and that's something to keep an eye on. And then lastly, some of the results suggest there's a very encouraging outlook for the next 5 to 10 years in this crypto industry. So let's jump right in. This is probably one of, if not maybe the most interesting question in the entire survey. So we tried to gauge people's preference rates for Bitcoin versus more traditional financial assets. So we asked them, would you rather own $1,000 of Bitcoin or $1,000 of stocks? Bitcoin or bonds, Bitcoin or real estate, Bitcoin or gold? Fascinating. The idea here was to really get an idea of, this should be suggestive of how people might deploy their next investment capital. Right? And overall, we found that 14% of people said they prefer Bitcoin to equities. I'm going to hone in on stocks and equities here because I think that's probably the most interesting and relevant asset class here. Now, 14% prefer Bitcoin to equities. To some of you in the room, that might seem like a low figure. 14%? Okay. But you need the important context here, which is that less than 2% of people own any Bitcoin today. So if 14% of people go out and make a purchase, that's more than a 10x increase in adoption from that alone. And the results are even more encouraging if we break down by age and if we look at gender skews as well. So what I have here is a breakdown by age. The blue bars are the total population within each age group, and the black bar is if we looked at the male segment in particular. So while 14% of people overall said they prefer Bitcoin to equities, 27% of millennials said they prefer Bitcoin to stocks, and 38% of millennial males said they prefer Bitcoin to stocks. So this in its own right is a fascinating story. But we said, hey, let's dig into the data and let's understand some of the components happening behind the scenes here so that we can get an idea of where we are in this trajectory. How aware are people of Bitcoin? How do they feel about it? So we asked them, how familiar are you with Bitcoin? Overall, the results are fairly encouraging. 30% of people describe themselves as at least somewhat familiar with Bitcoin. Okay, 30%, that's relatively high. But again, this comes back to the fact that we're in the first inning. There's a long ways to go. And even if we drill in and we look at those younger demographics, it's still only 42% of millennials and 50% of millennial males that describe themselves as at least somewhat familiar with Bitcoin. So even in that leading kind of cutting edge demographic, more than half of them have either only heard the name Bitcoin or they haven't even had that experience yet. We have a long ways to go. But okay, how do people feel about Bitcoin? Do they still think of it as something that's only for drug dealers in the dark web? Or do they see it as something that's more positive? And so we asked them, to what extent do you agree or disagree with the statement that Bitcoin is a positive innovation in financial technology? Amazingly, 34% of people agreed with the statement that Bitcoin is a positive innovation in financial technology. Remember, again, only 30% said they're even anyways aware or familiar with Bitcoin, and yet 34% see it as a positive innovation. And again, if we drill into those younger demographics, 48% of millennials and 65% of millennial males agreed that Bitcoin is a positive innovation in financial technology. This is interesting, but okay, awareness is relatively high, people have relatively positive views of Bitcoin, but that doesn't necessarily mean that they would put money in it. And so we asked them, would you trust your assets in Bitcoin? If you had to choose, which of the following is more trustworthy, banks or Bitcoin? 18% of people picked Bitcoin. We're talking about nascent 9-year-old software versus 100, if not 1,000-year-old institutions where the vast majority of people keep the vast majority of their money. That's an uphill battle for Bitcoin. 18% is a victory, especially if we consider that only 30% of people describe themselves as aware of Bitcoin. And again, if we look at those younger demographics as well, it's 27% of millennials and 30% of millennial males picked Bitcoin as more trustworthy than banks. Now, granted, a good friend of mine recently joked with me that, you probably should have had a control in this question and asked, which do you trust more, banks or some random stranger on the street? Because you might have gotten 18% there as well. And that's fair. So maybe this is more indicative of a negative sentiment for banks than a positive sentiment for Bitcoin. But regardless, it shows that people are open to exploring new alternatives. And in particular, the younger demographics are interesting here because younger people tend to have a greater expectation that software will improve their lives. So why not change the foundation of money and value transfer as well? So we said, okay, these results are all very encouraging, but what does it mean for future adoption? What does it mean for people buying Bitcoin? And so we said, okay, to what extent do you agree or disagree with the statement that most people will be using Bitcoin in the next 10 years? This is a very strong statement. Most people will be using Bitcoin in the next 10 years. So more than 50% in a world where today, in the US, less than 2% of people own any Bitcoin. That would be a huge move. That'd be a 25 to 40x increase in adoption. Overall, we found that roughly, 28% of people agree with the statement that most people will be using Bitcoin within the next 10 years, 42% of millennials, and 48% of millennial males. So this is interesting. And so we said, okay, if people are expecting everybody to be using Bitcoin, then they must be expecting to purchase it, right? So we asked, how likely are you to purchase Bitcoin in the next 5 years? We found is that 19% of people said they're likely to buy Bitcoin within the next 5 years. And 32% of millennials and 42% of millennial males said they expect to buy Bitcoin in the next 5 years. In this type of environment, it's no wonder why you have leading fintech companies like Square and leading financial institutions like Fidelity rushing to integrate Bitcoin onto their platforms and make it available to their clients. But okay, so to wrap up the survey section here before we move on to item 2, let's revisit those 3 major takeaways. The first is that we're out of batting practice, but crypto is only in the first inning. The second is that young people are leading the way as far as this technology shift goes. And then lastly, there's a very encouraging outlook for this industry for the next 5 to 10 years. Okay, let's talk about item 2 here. Bitcoin is a platypus. In order to understand what I mean here, we have to first introduce our dear friend, the platypus. Now, the platypus might be the most bizarre animal on the planet. This is a venomous, egg-laying, duck-billed, beaver-tailed, otter-footed mammal. None of those things are supposed to go together. In fact, this animal is so weird that leading scientists, when they first read accounts of it, they said this must be a joke, right? This can't be real. Those things do not belong. They cannot be in the same entity. So they said, hey, okay, send us over a sketch. Humor me. Send me over a sketch. They get the sketch. They laugh. Okay, this is still a funny joke. Why don't you guys go ahead and send me over a specimen, huh? So some people down in Australia, they taxidermied up a platypus, shipped it off to leading scientists. They opened up the box and they laughed hysterically. They said, okay, this just confirms all of our beliefs. But then they looked really closely and they said, wow, the platypus really does have all these features. It really is like a duck, like an otter, like a beaver, and it has features of a mammal and a reptile. It's bizarre, but it's real, and it works pretty effectively. Bitcoin isn't too different. When people first walk up to it, they say, hey, is this a currency? Is this a commodity? Is it digital gold? Is it payment rails? What is it? And I talk to investors all the time that struggle with this. And it turns out that just like how the platypus isn't good at being a duck, and it's not good at being a beaver, and it's not good at being an otter, but the platypus is great at being a platypus. Similarly with Bitcoin, when investors walked up and they said, is it a currency? And the currency people stood up and they said, sir, it's absolutely not a currency. It's not widely used for payments. Goods are not widely priced in it. It's 100% not a currency. Investor says, okay, well, is it a commodity then? And the commodity people stand up and they say, I've been in this industry my whole life. I cannot touch any Bitcoins. I've never seen one in my life. It is intangible. It's definitely not a commodity. Okay. The investor goes and says, well, maybe it's a fintech company then, and I'll call the CEO and talk to him. No CEO, no headquarters. So Bitcoin it's not good at being a currency. It's not good at being a commodity. It's not good at being a fintech company. Bitcoin is great at being Bitcoin. And just like for the platypus, scientists had to go and create their own category for it that is almost exclusively dedicated just for the platypus. We're seeing the same thing with Bitcoin and crypto assets today. They're unique in their own right. They have features of many different types of asset classes, but they are their own. Which leads me to my last section of how I think about some of the components of Bitcoin's value. So, okay, we're going to shift from Bitcoin as a platypus to Bitcoin as an iceberg. So if I'm sailing my ship and I'm approaching this Bitcoin iceberg, the first thing that people see on the surface there, on the tip of that iceberg, is payments. They've been hearing cryptocurrency in their ear. They see it and they say, this is definitely for payments. And they're right. Hey, Bitcoin is used for payments. It's not widely used for payments, but it is. I think it's an important part of Bitcoin's value today, and it'll be an increasingly important part of Bitcoin's value longer term. But the center of buoyancy today, the reason why people are buying it is as digital gold, as a scarce resource that is unseizable, that is highly censor resistant, that is permissionless and is decentralized. That is the reason why people are buying today. Below the surface, what is the most underappreciated component of Bitcoin's value, in my opinion, is its value as a natively digital and programmable asset. So what happens when you take something that normally exists in the physical world and you make it natively digital? You shed all of the constraints of the physical world and you unlock a new world of opportunities. I'll give you two early examples with Bitcoin today: multi-signature transactions and time lock transactions. Multi-signature transactions allow me to send Bitcoin to an address and specify that absolutely 100% those Bitcoins will not be moved from that address unless 2 of 3 people agree, 3 of 5 people agree, or whatever parameters I want to set to it. Now, some of you in the crowd might be thinking, hey, that's something, I can do that without Bitcoin. And you're right. You can hack that on top of the legacy financial system. You can take hours of legal time and cost, and you can duct tape that thing onto the financial system. Fine. But this has now been reduced to a couple lines of code within Bitcoin. This is the software eats the world thesis extended to financial assets and value for the first time. The other example that I was giving is time lock transactions. I can send Bitcoin to an address and specify that 100% those Bitcoins cannot move from that address until some specific point in the future. Again, this is software eating the world of financial assets and value. Overall, I think that this whole iceberg is the picture. Bitcoin is payments, Bitcoin is digital gold, and a lot of people are going to grab all of these puzzle pieces of a natively digital asset, and they're packaging them together in new ways that allow us to transact with one another in ways that we never thought were imaginable before. This is the value proposition of Bitcoin. So in closing here, listen, price goes up, price goes down. Inevitably in this industry, there will be significant pullbacks. These are young protocols that have their entire price exposed for their whole history. If we saw the price of Facebook before it went public, it would have been up and down in crazy volatile spikes. Instead, we see it with some of these assets. But here's what's not going to change. This technology is not going to be uninvented. These crypto assets are not going to go away. And I've never been more excited to invest in this ecosystem. I've never been more encouraged by the caliber and quality of projects and developers that are entering and building disruptive new technology. So if you're working on something out there, please come and talk to me. I'd love to hear what you're building. Thank you all so much for your time.
The next analyst we'll be hearing from is Tuur Demeester, who's the Managing Director at Adamant Capital. Could you please give him a warm welcome?
Oh, thanks. Thanks, Spencer. I think that was great. So yeah, my name is Tuur Demeester. For the past 6 years, I've been trying to understand cryptocurrency markets. And so just let's see how this clicker works. Oh yeah, and so today I just want to share some thoughts about what I'm seeing. Some high-level thoughts first, like the 3 phases in Bitcoin, about how I see the ecosystem evolve. And then I want to share some analogies that help me personally understand the platypus that Spencer was talking about, to help me understand better what's going on and to compare and contrast it with some things that have happened in the past. And then finally, I'm going to close with some thoughts about the next 12 months where things could be going. So the first phase of Bitcoin was a phase where developers and hackers were themselves still struggling to understand what Bitcoin really was about. And so everything was command line based, very high barrier to entry. And so from an investment point of view, the best strategy at the time was just to buy and try and not lose your Bitcoin. Like that was a lot to be able to do that then. To be trading was extremely risky at the time, so probably ill-advised. So that was 2009 to 2012. Then I think the San Jose conference in Silicon Valley in 2013 was kind of like a landmark event because you saw that people were working on, for example, ASIC chips for Bitcoin mining. You also saw that a lot of exchanges were being started up because people were identifying that Mt. Gox was a bit of a risky proposition as far as exchanges went. And so from then on, you saw a lot of work happening on infrastructure. So developers started working on the Bitcoin stack, just improving the code, making it more efficient, allowing for more privacy, working on on-chain scaling and also off-chain scaling. So I think that's going to continue probably into 2019, 2020. So basically, we're talking about developers that are creating the equivalent of TCP/IP, UDP, the email protocol, to then, mass deploy after that. In the infrastructure phase, what I think you also see is what I call custody hardening, where custody solutions are tried, they're tested, and when they fail, new and better solutions do show up. And then because more investments in infrastructure allows for more investors and users to come in and for more money to flow in, that also attracts scammers because they know that it's a high barrier to entry as far as information goes. There's imbalances with regards to information, and so they use that advantage to deceive investors, and you see all kinds of scams. At the same time, in this phase, we see institutions come in. So very early on, it was angel investors and family offices, and now hedge funds are coming into the space. So that's definitely part of this too. So for the investor, I would say that the strategy would be to not only hold Bitcoin, but also, dabble in a basket of what you could call e-gold contenders, protocols that might be complementary to Bitcoin, that might add value to it directly. I think it becomes more valuable to trade because even though the individual exchanges might themselves be still fairly early days and not very mature, but at least you can diversify your risk over the space because there's many of them. And then as far as VC investments goes, infrastructure, so that means exchanges, hardware producers, really focusing on the rails. And so that the analogy here would be the what Mary Meeker advised in 1994, I think, is when her report came out. She also said to invest in the infrastructure of the internet. And I backtracked it, and I believe that her recommendations did outperform the NASDAQ over the long term. So just to illustrate again why this is an environment that's interesting to trade assets in, this is a chart I published last summer, just Litecoin versus the dollar. You see these triangles and then a breakout and another triangle, and yes, it did break out. It doubled after this in a month's time. So definitely an environment that is, and I think the reason why these charts work, even though some people don't particularly like technical analysis, I think why these setups do work more often than in traditional markets is because the psychology is still very raw. A lot of unexperienced traders are active, and so you get a lot of fear and doubt that enter very quickly. And then if you're more experienced, you can exploit that. Of course, you can also do a lot of arbitrage, those kind of things. So the third phase in Bitcoin, I think, is going to be the deployment phase, where we're ready for the mass markets, the 1995 moment, if you will. I think that could start from 2019, 2020 onwards. Why? Like several reasons. First of all, I think that'll be a time where the custody is going to be a bit more mature, so it'll be able to support actually large amounts of people that want to maybe trust a third party to hold their assets. So that's one. I think we might also see global macro tailwinds, where all of a sudden there is a big demand for a politically neutral liquid store of value. And then purely looking at adoption, in 2015, 0.8% of US households had some Bitcoin. That was incidentally the same percentage as US households that had an internet connection in 1990. So in that sense, maybe 5 years could be 2020 for Bitcoin. So ready for the mass markets. What does that mean in terms of investing? In addition to holding Bitcoin and investing in the infrastructure, what I think could be interesting in that period is to really look at second layer cryptocurrency applications. So that's when I'm talking about sidechains, maybe the payment channel technology, those kind of things are going to be at least deployed, and so should be ripe for investing. Blockchain to blockchain trading, so we'll see more sophisticated decentralized applications. We might see assets being issued on top of blockchains in a more mature way than what we're seeing today with ICOs. I think all this is very early and is going to prove largely too early, so maybe 2020 might be a good period for that. Bitcoin e-commerce, brokerage, and banking service providers. So moving on to some analogies that work, and I really like the image of the platypus that Spencer used, because really it is very hard to understand, and so what's worked for me is to look at specific aspects and then try and see if there are any analogies in the past that make sense and that help me link it to things that have happened, and then I can read about those things. So for example, the Forex market in the 80s, which was the very early days of Forex trading, the analogy would be that there's lots of opportunity for arbitrage, that there's lots of risk, that volumes are fairly low, but you have to keep in mind that there are no bailouts, there's no lender of last resort. Most of these exchanges, the vast majority, are not insured, so the risks maybe are bigger even than back then. As far as VC investing goes, the obvious comparison is maybe the dot-com era, where you did eventually have the Googles and the Amazons that came out of it, but also you had the Pets.coms and the Enrons. So definitely, a very polarized environment. The difference with then is that today you're actually able to invest in the equivalent of TCP/IP or the email protocol, right? You can just buy the actual protocol, and that is Bitcoin. And then as far as value distribution goes, the top-level domain market is interesting there, I think. So what I mean with value distribution is if you look at the market caps of all these cryptocurrencies, how is that balance going to be? Are we going to have a FANG kind of environment with 5 dominant ones and then a long tail of small ones? Are we going to have a duopoly? Are we going to have a winner-take-all, kind of like with TCP/IP itself? And so one market that I find fascinating to study is the top-level domain name market. So what that means is the .com names, for example, is one top-level domain name. The .nets, the .eus, the .rus, and so on and so on. So what you have there is a digital asset that, in a way, is infinite. You can imagine, infinite amounts of domain names, but at the same time, you see an order emerge from that market, kind of like a virtuous cycle that started to develop. As people identify that .coms were associated with somewhat better quality, they bid more for those domain names. They became more valuable. And then entrepreneurs that wanted to have that image of quality started to also, use those domain names. And that is actually backed by studies that show that of the .com names, only 0.5% is associated with malware. And that's significantly better than .nets, .orgs, and of course, way better than .science. I believe that half of the .science domain names are associated with malware. And so similarly, in cryptocurrency, the suggestion would be that eventually you'll have one .com equivalent, and then a long tail of very small variations that are associated with a lot more fraud, but at the same time with a much lower barrier to entry. Because Bitcoin transactions aren't free. So if you look at the value of transactions in the domain name space, I'm told that over 90% of the value of the transactions is in the .com. So pizza.com will be $10 million, and pizza.net might be $50,000 only. And then talking about adoption, if you look at Bitcoin just from a purely, dispassionate, this is a technology, it has mass appeal, how is it going to be adopted? Well, then you can look at other technologies that had mass appeal, how were they adopted? So like the radio, television, refrigerator, air conditioning. What you see time and time again is an S-shaped adoption curve, right? So at the top is 100% of the population, the bottom is 1%. So you see that happen. So a very slow start, and then it ramps up. And so I think that helps us make sense of the Bitcoin price movements, right? Any trader, investor who sees a graph like this might just, really want to stay away because this is unsustainable, it's going to crash, et cetera, et cetera. But then again, if you look at the same chart on a logarithmic scale, all of a sudden it looks like a very orderly ascent. And so what I'm suggesting is that this might reflect that steep slope in the S-shaped adoption curve, right? And so it's because of this that projections in the future of Bitcoin being $100,000 or more, for example, this graph suggests by 2022 we would have a Bitcoin price north of $100,000. I think those kind of projections are not absurd to make, right? Even $1 million Bitcoin. If you think about the kinds of markets that are being disrupted, right? Censorship-resistant, liquid store of value, that's about a $100 trillion market. These kind of projections are not totally outlandish. So just a few thoughts looking forward. I think the next 12 months we're going to see even more institutional involvement, and I mean from all angles, right? Not just investments that are being made, hedge funds, family offices, pension funds, et cetera. But also on the supply side, we'll see very established companies that come up with their own ways to contribute to that infrastructure, right? To have better storage solutions. I think we're going to move to smart custody, for example, which is just using multi-sig technology, time locks, hardware security modules in specific combinations that are more secure than what we have today. So I think that's very exciting. Second layer scaling is going to be an important part, not only of the conversation, but I think we'll start seeing actual applications, the deployment of the Lightning Network, for example, I think we'll see. And so that'll show off that Bitcoin is more than just, this thing that you can hold, and over time it goes up in value, and it's $3 per transaction. I think we'll start to appreciate that it can do a lot more. And then finally, for the next 12 months, I'm expecting some kind of stress test. I don't know what it's going to look like exactly. If I had to bet, I would say that the current custody infrastructure is not sufficiently mature to support the current valuations. And so if you think about some of these custodians, they started off when Bitcoin was maybe a $5 billion market cap or smaller. And so, you know, they're maybe not built to sustain the kind of pressures that we're seeing now, where if they're storing $1 billion in Bitcoin or 10 billion, which some do, that's a $10 billion bug bounty on your head, right? That's enormous pressure. And I think that maybe even state actors eventually might get interested to, you know, to really stress test the system, even on the protocol level. So that's just some thoughts there. And that could, of course, cause market trepidations. Thanks very much.
Up now for our third analyst we'll be hearing from, we have Willy Woo, who's the cryptocurrency researcher at Helion. Could you please welcome him to the stage?
Trace forward. That one? Oh, just one. Thank you. Hi, guys. Let's see. My name's Willy Woo. You can probably tell from my accent I'm not from around here. And that's true in a deeper sense in that I am not Wall Street trained. I'm not a fully trained analyst. My background is in the field of engineering. So I'm a design engineer. I was trained as an engineer, product design, and I went into startups. So I've had a lot of experience with new technologies. And just in the last year, I've been full-time trying to understand this emerging crypto space. So essentially what I do is publish my brain farts. You can follow these articles on woobull.com, or you can follow me on Twitter, where I kind of do the short form. I'm often too lazy to publish a full article on some of these ideas. But yeah, I'm trying to understand the markets. I'm trying to understand the traders through data analysis. So some of my work includes this 3 cats and a moon pattern, which if you looked at the trading pattern of Bitcoin from early days as early as 2011, 12, right up to this year, early part of this year, whenever we had a moon ride, it was a 2-stage pattern, it would retrace, would re-enter, and we would have 3 bounces, not 1 dead cat, but 3 before the next pattern. Whether it was a bull season or a bear season, that pattern would exhibit. I published this on CoinDesk's, and the moment that got published, it failed to repeat that pattern. And it was a pretty interesting time in that ETF announcement failed, and because hedge funds could not get into Bitcoin through a ETF instrument, they started to come in around the March, April phase of this year, and you saw that in the price climb of Bitcoin, and I saw that in this pattern changing. A new animal had arrived into the Bitcoin space. The psychological trading pattern did not match. And interestingly enough, a few months back when we had the Bitcoin Cash fork, Bitcoin Cash started trading the 3 cats and a moon pattern. So the old Bitcoiners were in that market and the hedge funds hadn't arrived. So I'm also responsible recently to publish this so-called NVT ratio, and it's the closest thing we have to Bitcoin's price-earnings ratio. It's effectively the amount of funds, amount of monies flowing through the Bitcoin blockchain. If you take that as a ratio of the market valuation, you get this ratio, and this ratio works like a PE ratio. So in the chart there, the red line is the Bitcoin price over a log chart, and in white, obviously, is the smoothed out ratio. And you can see just like a young company that's high growth, you get a very high ratio. And as the trajectory starts to level off, you get trading or moving within a band. Within those 2 dotted lines is the normal trading phase, trading range within NVT. And whenever it goes above that, you can say it's probably a bubble. That, in other words, the money going through the blockchain is not really enough to sustain the valuation that the markets are putting on it. It's kind of laggy. You won't see this indicating bubble on the upward mania phase of a bubble. You'll see it always in the dead cat bounce. And obviously, we're getting close to the top end, but we're far from this being a bubble right now. What next? Maybe the next. All right. We're really early in cryptocurrency. If you take the market cap of where we sit today, all of the altcoins, all of Bitcoin, the valuation is less than 0.5% of the global fiat money supply, M2 money supply. We're around 70 million users. Maybe it's 140, 1 to 2%. Let's be conservative. 1% of the world population are users of cryptocurrency. Now, this is doubling every 12 months. So there is, in this phase at least, similar to what Tura was saying, we're in this adoption phase. It's doubling every 12 months, every year. And I did a bit of research on this. To get to this figure, I took data from Google and looked at searches for USD Bitcoin price. And presumably, if you're interested in buying or you're holding Bitcoin, there is going to be an uptake of searches looking at the price via Google. And more searches when like price action is heating up, less searches when it's boring. But there is a steady baseline, and that is essentially doubling every 12 months. So that's where this figure is coming from. And you can extrapolate where we'll get to on this trajectory. And what I've done here is I've charted M1 US dollar, M2 US dollar money supply, and underneath there is Bitcoin network value. That chart, Bitcoin was what, 2009 it was invented? It goes below that, and it follows that curve. We only really had markets that started opening up around 2011, but that's the trajectory. Well, remember, this is 0.5% of money supply at the moment, but really, we're 2/3 of the way to achieving a crossover with M1 money supply. By 2022, countries are going to take this seriously. We're saying Bitcoin is going to be a challenger to the current world reserve currency. And that's kind of ludicrous to say, but that's the trajectory we're on. So remember, that's 0.5% of the money supply, and it's got a long way to grow. And obviously, Bitcoin's not the only story to look at. We've got Ethereum, Monero, Neo on this chart. There's a lot more. I took out some of the other top 10, top 20 altcoins just to make this chart clear. But you can see they're on a very steep trajectory. They're, in fact, steeper than Bitcoin, and they're threatening to cross over even earlier. So a lot of opportunity in this space. And I'm going to zoom out here and look at the 10,000-year view of cryptocurrency. We've had gold money since the dawn of civilization. Since we moved into an agrarian age, we use gold coins as money, and we hit this thing called the Industrial Revolution and entered the Industrial Age, and money had to be a little bit more portable, and we just started trading receipts over gold, and in 1973 we went fully fiat. Now, if you can agree with me that since the 60s, 70s, 80s, 90s now, we're going through a new revolution, which is digitizing the world, and we're moving into a post-industrial age, then you'll probably agree that cryptocurrency, well, money itself and commerce has to be digitized. And the invention of Bitcoin is not just the invention of some programmable money. It is a fundamental invention of digital scarcity. And when you have a digital scarcity that can transact over an internet native communication line, you're going to complete this digital revolution. We've got softwares eating the world. We've got the Uberizations of taxis. We've got Airbnb taking over hotel chains in volume. And now we can finally look at Wall Street, money, smart contracts, digitizing this. And so, no, we're not in a bubble. You know, what was it, 2013, we were talking about Bitcoin as drug money, and now 2017, we're talking about Bitcoin being the biggest bubble of our generation. We're not even 1% of the way to this fully digital environment. And it's going to be bigger than the world money supply. The equity markets is bigger than the $60 trillion, I think, M2 money. I think equities markets is $70, $80 trillion. I'm told by the Propy guys that the real estate markets is somewhere north of $200 trillion. So this is all going onto blockchain. So I'm told, bringing it home, maybe what's going to happen closer to where we are now. What are we doing with crypto assets in 2018? Well, this is how I see where we are right now. Typically, in any investment cycle, you get the 4 stages. You've got stealth, awareness, mania, and blow-off. And typically in the stealth phase, we're looking at the smart money getting in. And we didn't have that with Bitcoin. We had the geek money. You know, the smart money didn't come in until probably after it hit $1 billion, and it made notice. $1 billion is a little bit more to take notice of. And so we had some more savvy investors that were very tech-centric that came in. And normally in that phase, we have you guys. We have the institutional money. And you guys would have also been fired if you had bought Bitcoin in that phase. And you had regulatory issues. You could not have bought Bitcoin back in the last few years. So what we're seeing now, I think, is we're going from the awareness to the public mania phase, where the retail money comes in. And we're seeing a superposition of institutional money and public money. And we're going to see this thing blow really high, higher than normal, because the institutions are late into the game. So looking at the whole market and zooming in over the last few years, we used to see Bitcoin as being 95% of the crypto market, and it's on a downtrend, right? And this is the trend over many years, and we're seeing that it's roughly about 50% of the markets right now. And I see this as healthy. This is like in a fully digitized economy, you would not expect the money supply to be 95% of the valuation of all world asset valuation. And so we're starting to see protocols come in and take some of that market. Eventually, we'll see applications being built. And I would say Bitcoin will be a minority. And I don't know how low it would go. And I don't even know if this should behave like an S-curve, like a reverse adoption as we build out a full economy. But if we zoom into this chart and go, let's look at what's making up this dominance. Here is a picture of the top 125 coins. The fat lines are the higher market cap ones. The thin lines are the smaller ones. And you can see roughly 2/3 are outperforming Bitcoin. They're on a much steeper trajectory. And so there's a lot of opportunity here. Some of it is as steep as the 2010 years of Bitcoin. And let's look at the full picture. This is 1,000 coins. I've also plotted 1,500 coins. It's very much the same. And you can see if you bought the entire market, you'd be not winning. You'd be buying for $1, and X years later, it's still at $1. But you can see in there, I've color-coded, the reddish stuff is more the top 200 coins. The next one's, like the green is the next, like 200 to 400 coins, and so forth. And you can see that the winners are outperforming, and there's a lot of room here to vet the winners from the losers, and there's a lot of rubbish on the market. So once you start looking at this field like a venture capitalist would, is the technology solid? Does it have a use? Is it a platform? What's the end size of this? Is the team solid? You can start filtering this stuff, and you can get back to hopefully picking the winners. Maybe you can pick the winners that are going to be in the top 20 and therefore get the kind of gains that we saw as the, the geek money made by being in early. So this is a strategy that I think would work quite well, is to try and find these winners. And if you do find a winner, you'll notice that they all follow what I call, well, this looks like the trajectory of Bitcoin, and I call it the Falcon 9 rocket thesis of investment. You're trying to find a rocket that's going to climb in altitude. Each level of altitude is a 10x, right? You're going 10x, 100x. And so even in that flat region up top, you're still doing a 10x every, 18 months or so. But we're talking about doing the 10x in the 6th months, if you can get onto that equivalent of a hot startup like Google before it goes big. And you can ride that for the first maybe 2-3 years before your 10x per year is not good enough. And you can then look at the next round of promising protocols coming up. And we've got a zone to do this in for the next, I don't know, maybe 5 years before this starts to be mature. Right now, we're seeing a lot of rails being put down. The likes of Ethereum, NEM, Monero, these are all protocols for different uses. And you can think of them as railway lines, and they're carrying loads of cargo, which will be commerce. They'll be our smart contracts. They'll be the apps that people build. There'll be the new Facebooks being built on the stuff, and it's all going to be built on these protocol stacks. So look for them now. It's very early. I don't think we're anywhere near finished with building the kind of protocols we'll need into this digital age. And that's it from me. You can catch me on Woonomic on Twitter or my blog at woobull.com. And thank you very much. Enjoy the conference.
Up now, we have Alex Sonneborg, who's the founding partner at Tetris Capital. Would you please welcome him?
Hey everyone, my name is Alex Sonneborg. Today I'm going to be giving you a quick presentation on the current state of the crypto market with a big focus on ICOs, opportunity cost, and liquidity, or rather illiquidity as you move down the space. For some context, I'm currently a founding partner at Tetris Capital. Tetris Capital is a crypto hedge fund that invests across the asset class. By across the asset class, I mean we evaluate opportunities from the largest and most liquid markets like Bitcoin, all the way down to early stage illiquid pre-ICO SAF deals. So let's dive in. This is going to be a pretty dense presentation. So I'll probably post these on Twitter with a blog post shortly after this. So for starters, I obviously think there's vast opportunity across the entire space. That's why we set up our fund to be as flexible as possible and take advantage of these opportunities. As I'll show you shortly, some of these ICOs have returned absolutely massive magnitudes on both longer term, so a couple year timelines here in crypto, as well as pretty large magnitudes on shorter time scales. The thing is, if you're playing in these smaller, more illiquid early stage markets, you just need to do a lot more diligence in terms of the actual technicals and economics of these protocols. You need the actual network to get in touch with and negotiate with these teams. And the actual risk of legal and technology is a lot here. And by that I mean oftentimes the founders actually need to build this protocol or this decentralized application, and the ICO actually needs to happen for you to get liquidity. So when you're considering an investment in an ICO, I very much suggest that you compare it to something like Bitcoin. Think fully through the sort of upside and downside magnitude of returns and the probabilities of that, and that I typically mean of the overall valuation that this ICO could get to. And generally think about the liquidity. So what's the minimum time it could possibly take for you to be able to sell this if you wanted to? And if you did want to at that point, how hard would it be in terms of how long would you be in the actual order books, or how much slippage or fee would you pay to an exchange or an OTC desk? So let's look at the liquidity amongst these top tokens. So here I have the top 25 tokens by market cap and their average daily trading volume. Obviously, the biggest ones like Bitcoin and Ether are now trading over $1 billion a day usually. These are pretty easy to get in and out of for even the largest funds in the space. The concerning part is as you move down this asset class. So over half of this group has an average daily trading volume of less than $50 million. On top of that, these are spread out across exchanges and geographies, and it actually gets a lot worse than even this. So before I dive into sort of some stats around ICOs and liquidity, I wanted to at least back up and talk to you guys about how I generally think about fundamental value, which is an area I like to start with and at least understand what the big drivers are and compare them to other assets. Although for day-to-day trading, this really doesn't mean too much, and the markets move a lot faster. So generally, I have them divided out here as currencies, so actually tokens used as medium of exchanges or units of accounts within systems. So it's easy to think of a token like our money today that are used in the world GDP and economic activity, but also by currencies here, I mean decentralized application tokens. Tokens that are actually used to access these decentralized services like storage, gambling, or computation. By that, I also think these dApp platforms have certain aspects of currencies as well. You actually need something like Ether to transact on the Ethereum network, to create a smart contract, or to interact with a dApp. This is kind of opposed to these store of value tokens, those that I think you're incentivized to hold longer term, those that you really don't want to transact with day to day. You'd rather hold value there, that are either going to appreciate due to just general long-term price appreciation, or actually getting some sort of future value back. So I'm going to dive into sort of some of the similarities and differences by going through some examples of these. So generally, if you're looking at a valuation model, you need to start with some overall target addressable market. So a really easy example is something like gold for the store of value side for a money token. From there, you need to basically multiply it by a % market share that this protocol will take from this overall market, or perhaps it can add some to it by offering this decentralized alternative, and kind of model this out over time, as I've indicated by these arrows. So as you model out, as this market share grows, you then need to also discount at any time for this risk that maybe the market share won't be as high as you thought, or the entire protocol will come crashing down. You also need to think about discounting this back in terms of opportunity cost of investing in any other asset, whether that be cryptocurrency or something traditional. Now, the main difference here is that these currencies have this concept of velocity, which is directly tied to how much this token actually changes hands within a certain economy. So these transactional tokens end up having a lot higher velocities than just store of value type currencies. They change hands a lot, and due to this formula, they end up having a much lower valuation. So let's get a little more nitty. Obviously, you could probably tell by now, I think these money tokens have aspects of both currencies and stores of value, whereas some of these decentralized application tokens are only function more as currencies. It doesn't really make sense to hold this token over time. It's something you can buy into, use within the dApp, and then sell out of, which increases the velocity and thus leads to a lower valuation. So if we're modeling something like Bitcoin, I would pick something like the GDP or money supply as the overall TAM on the currency side, and maybe gold on the store of value side. Take my % market share, divide by velocity. Bitcoins you can actually calculate historically is about 5. Add these values together and get some sort of total asset market cap example. Something of Bitcoin in the hundreds of billions probably implies something like a couple % market share in each of these categories. Now, with something like Zcash, very similar markets, another money token, perhaps you can add some element of the gray market TAM, so for more private transactions that Bitcoin doesn't quite address. But I would argue the market share right now of each of these are much lower, and you can see that in the valuation as well as in the actual numbers of transactions on this network. This is contrasted to something like Funfair, where the overall TAM is something like the global gambling market, which is going to be a lot less than something like Bitcoin's more money TAMs. So this is something in the billions, where Bitcoin's is in the trillions. Again, because this is a gambling token, and it's something that you're likely going to be transacting with very frequently to make bets or to move tables or any other thing like that, the velocity is going to be a lot higher, which is going to lead to a currency dApp token like this having generally a lower valuation than something like a money token. Filecoin, very similar model. Here you would probably project out the cloud storage market over time. Rep, totally different type of token. So how this works, this is one of these future value-backed tokens I'm talking about. So Rep is not actually needed to gamble on the Augur platform. REP is actually this token that incentivizes REP holders to serve as oracles to help settle future prediction markets. And as a incentive for doing so, they actually get a percentage of fees of all bets that are waged on the Augur network. Thus, the valuation model of this is simply projecting out how big these markets you think will be over time, how many you'll help settle, what percentage of that goes to Augur rep holders, and discounting all those future cash flows back and taking into account, of course, the risks that the protocol even launches. So Grid Plus, another custom example. Grid Plus here has actually 2 tokens in its system, which is more and more popular these days. One's more of a stable coin actually used on the network, and then this grid token is used for both fundraising and sort of the initial way to gain a user base. So grid is actually redeemable with the issuer grid for electricity at wholesale pricing, whereas you as a normal retail customer would usually pay the retail price, thus giving you a pretty obvious fundamental value of that spread, discounted over time for the actual redemption schedule that grid actually lets you redeem on. So obviously I said, this is all pretty high-level fundamental stuff, very just driven on your inputs, a lot longer term than what actually drives markets day to day. Now, I could talk about this for like hours. There's many things. On the money side, you, of course, look comparatively at like transaction numbers, the value, how that goes into velocity. You look at things like blockchain forks, new exchanges listing tokens, especially when they don't have previous trading volume in that region, and just generally knowing the composition of token holders, what kind of buyers and sellers they are. Are they long-term hedge funds? Are they more short-term flipper types? There's a ton of things that go into day-to-day trading. Early stage investing is a lot more VC-esque. So, a lot of times you don't have network statistics. There's not even investors present in these rounds. You have heightened tech risks. This blockchain isn't live yet. And also the liquidity risk. You might tell me the ICO is in 3 months, but we all know that could get pushed off or even completely canceled. This regulatory environment's quickly changing. So again, you really need to think here in terms of opportunity cost versus holding something like just Bitcoin. And overall, the liquidity of it, and generally, as we'll see herein, a lot of the top returners have been with really small ICOs. So it's beneficial on a percentage return basis to be pretty small and move pretty nimbly by either getting in early or out quickly. So generally, I've illustrated this journey to liquidity as basically Bitcoin and Ether on the right are like your gold standard. That's where every token wants to get, these large liquid markets. But let's think about an early stage SAF deal that starts on the far left. So here you have maybe this project that's going to launch a new blockchain or a dApp in a couple years. So at that point, you have this huge element of tech risk. Are they actually going to figure out how to make it? Let's say they do and make a lot of progress. Your next big thing, legal risk. Are they actually going to be able to do the ICO? Is the entire regulatory market going to change? I have this star here to signify, does the actual dApp have to be live and have some functionality before the token can be launched, or else is it considered a security? There's a lot of moving parts here that are just very uncertain. Let's say they actually do have the ICO. Then the next element is, are these tokens actually transferable? Has the issuer given you these tokens, and can you actually move them in your wallet? Or is there some element of lockup or vesting? Let's say you can move them. Where are you going to move them to? It's not a given anymore that these exchanges will list new ICO tokens very quickly, given how many new ICOs they are. So this has given the rise to a lot of trading volume on decentralized alternatives, such as Ether Delta. So quickly, let's look at this ICO history just to get an idea of how these sizes have grown. Ethereum was massive with $18 million about 3 years ago. Now we've seen deals easily 10, almost 20x that size. This has led to this cumulative ICO funding chart to blossom to about $3 billion. As of about a year ago, it was 10x smaller. 2 years ago, it was about 100x smaller. One thing that's interesting is I think sort of the overall AUM of the crypto hedge fund space or institutional investment looks pretty similar to this graph, which makes a lot of sense, and I think it'll kind of continue to do so as a lot of these ICOs start to lean towards this sort of safer pre-ICO institutional investment route. So if we look at the ROIs on why these opportunities are attractive, it makes a lot of sense. The top returners here are over 1,000x. Ether's the best example, up over 1,100 since its ICO. If you invested $1,000 in it, you're now a millionaire. The number 25 returner on this list is up 20x, which seems great and is on an absolute basis, but again, you really need to compare these to just investing in Bitcoin over time. So let's kind of lay out some of this data. I've laid out the token return, the return against Bitcoin and Ether, the average daily trading volume, and ICO funding. I'm going to filter this list to really look at what were the most successful projects. There's a lot of noise here. So if the ICO did not beat Bitcoin or Ether, I'm going to color it red. If it only beat it by less than 2, it's going to be concerning, maybe not worth the additional risk. On the funding side, if it's less than $1 million deal, you probably wouldn't have heard about it, you might not have gotten involved, and you definitely wouldn't have got a lot of money into it. On the average daily trading volume side, I'm going to put everything in red. That's less than $1 million to really signify this is not a position you could actually take large profits on. The value that's stated by these positions, if it has $100,000 worth of trading volume, it's not really significant, especially as a large investor. So let's filter this list. Here, we can see that basically 70–80% failed one of these criteria points. Tiny ICO, didn't beat Bitcoin or Ether, not liquid enough to trade out of. And we can really then filter the list to see what these top returners were. And interestingly, it was a lot of dApp platforms. Neo comes in right behind this Ether list, QTIM, OMG pair. So let's look at it by deal size. So on the left, we have the largest ICOs. On the right, little red dots, we have their ROI since ICO. One interesting thing about this data set is you can tell they're all on the far right. It seems like the smallest deals had the largest returns. Let's see how small, though. Let's filter out everything under $2 million. We lose about the entire list. Only Ethereum is left at that point. A lot of these high-returning ICOs were in really, really small deals. So we can look here, kind of how did the big deals do? Most of them have not done that great, mostly underperformed Bitcoin and Ether. The ones that are still TBD have a lot of work to do to catch up on how Bitcoin and Ether have done since those ICOs. If we look at just large ICO performance, I filtered down to 45 largest ICOs, all with trading tokens. They happen to all be over $20 million, and in 2017, and we can see if you invested into each ICO, you actually would have lost to Bitcoin. Not only that, if we use that same criteria, most of these tokens are not liquid whatsoever, so you couldn't even sell out of these positions if you wanted to. Here we can see that OMG and Power Ledger were these really good returners, rated in 0x following, but again, trading less than $2 million a day. So if we look at this another way, we can also see that since 2017, or 2017 deals only being a whole different sort of ballgame, we can see that we're only left with this one deal, XSpec, or Spectre Coin if you're not familiar. Again, $15,000 ICO, $30,000 of active daily trading volume. Not a good data point. So let's filter this out. Here's what's left in 2017. And when we go down to this list again, this is the most concerning thing I've seen in a while. Probably 80+% of these top ICO returners in 2017 have a couple $100,000 active trading volume tops. These are not good examples of good ICO returners that you could have made substantial profit on. So what you can actually do is trade short term. All these stats I've shown you so far are on long-term returns if you would have held it to date. What I'm showing you here is that 0x popped 9x of its ICO price within about a week of it. But what's even crazier is if you look intraday. The day, August 19th, that I have in the upper right, is the day it was listed to Poloniex. It actually traded north of 60x for those first trades. So the fastest movers that got their deposits to Poloniex first and put up the first orders ended up making 5x more than these 9x end-of-day returns. So again, on the liquidity side, here are some known holdings I know from a large institutional investor. Here are a bunch of Ether dApps they own, the quoted current position, and the active daily trading volume, which are, a million less, some even, in the tens of thousands of dollars. This ratio of position size over daily volume is what really concerns me. At Tetros, we generally like to think as a rule of thumb, if we are considering a position of about 10% of an asset's daily trading volume, we think that's a bit high, and we're going to start to see slippage and the inability to exit efficiently. So when you see things 100 plus X, it really makes you question how much this position is actually worth. So as a conclusion, basically, mind the corny acronym, please, but if you're considering an investment in the ICO space, you really just need to tell yourself or really think about the liquidity profile, the comparative risk versus something like Bitcoin or something already trading live on the market, and just basically said differently, the opportunity cost of trading other assets. This is a whole universe and asset class, and you should consider risk, reward, and opportunity everywhere. Thank you.
So our final analyst is Haralabos Vulgaris, who is the managing partner at Corner 3 Fund. Would you please welcome him to the stage?
Nailed it, by the way. All right, let me see if I can figure out how to work this thing here. Give me a second. All right, perfect. So my name is Raul Bos-Folgueras. I'm primarily known as an NBA bettor. I've been betting on the NBA for about 20 years. I've been investing in crypto probably since late 2012, early 2013. I think we've all been here a pretty long time today, so I'm going to keep this relatively brief. My approach to betting on NBA is primarily quant-based, but I still do a lot of subjective analysis within that. I put together a pretty good team of quants to help me with that. Pretty lucky to attach myself to them. Basically, my crypto trading is quite similar in the sense that we do a lot of quant stuff, but then some subjective analysis within that. The main thing that got me involved in Bitcoin and crypto was trying to basically diversify my investment portfolio as a personal matter. I grew up in Canada, but I quickly moved to Monaco when I got a little bit older. One of the things you do when you're there is you go visit your bank and they tell you, this is how you should be investing your money. I'm sure everyone's had this conversation by some banker who's trying to basically get his hands in your pockets. What they want to do probably is give yourself a diversified portfolio, whether it be 70% bonds, 20%, or 70% equities, 20% bonds, and then maybe some precious metals in addition to that. I basically took the opinion that I wanted to have Bitcoin in there and maybe toss out most of the bonds and some of the precious metals. I took a pretty aggressive approach. When I was younger, I wanted to have about 30% of my net worth in Bitcoin. I wouldn't recommend that, but for me it seemed like a decent number. I went with that, and I've been pretty pleased with that, obviously. The great thing about investing in crypto is, even if you were to get involved in it today, it is a completely uncorrelated investment. So you can actually diversify your portfolio and reduce your volatility and also increase your Sharpe ratio, which is good. It says here top token traders. I'm not a token trader. I personally am not a big fan of tokens. I think for the most part, most of the tokens are trash, to put it bluntly. I think there are some good tokens within the space, but good luck finding them. And if you do find them, like the guy mentioned before me, you probably would have done better off if you just held Bitcoin or even Ethereum for that matter. So my investment activity is basically long-term buy and hold for the most part, although I am looking for some short-term opportunities to enter in at better exit points. Myself and my team, we also do some algorithmic trading on, as far as our fund goes. It's a private fund. And the things I'm interested in, again, not the tokens, but actually the currency coins. So what I mean by a currency coin is something that has like basically three qualities. One of which is it serves as a store of value. It's a means of exchange, and it's a unit of account. I think you'll find right now that there isn't really any other coin that serves those three purposes better than Bitcoin. I don't anticipate any other coin taking that over in the near future. You can add in something like Ethereum, which actually gives you the ability to do financial contracts or smart contracts. That's something that Bitcoin doesn't do now, but it possibly could do later on with different layers. And then you have some other coins that I'm interested in, which are mainly the privacy-centric coins, such as Monero, which deems that all coins are fungible. How I go about evaluating these coins are basically, it's pretty simple. First thing you do is you read the white paper. The white paper should be specific and detailed. It shouldn't be like a marketing pitch. It's a technical document. One thing you'll find in a lot of these ICOs is the white paper is like a brochure trying to take you on this great vacation of some sort. It's absolute trash for the most part. The technical details in the white paper should be technical. It shouldn't be a sales pitch. The other thing I like to look at is who are the developers, how decentralized is the coin governance, and how decentralized is the mining, and then does it even need a blockchain, right? The guy before me was talking a little bit about some of the gambling sites and how you'd buy a token to gamble. If I want to gamble online, I can gamble in Bitcoin. I don't need to have a Funfair token to gamble. I can use Bitcoin for that. I don't really understand the need to have a separate token to gamble online when I can just gamble in Bitcoin. And then if you're doing that, what are you exactly investing in? Are you investing in the ability to gamble? That seems like a pretty bad investment. Just, hey, I'm going to buy a token so I can actually gamble and lose more money. Doesn't really make sense to me, but I don't know. I'm a little different. And then what problem is it solving and who is buying it? When I say who is buying it, I mean what market is the coin actually trading in? You'll find some of these markets right now and some of the coins are only trading on one or two exchanges, which presents a lot of problems. For instance, for people like to take an index-based approach, that can be very easily manipulated. Imagine you had a big fund that wanted to have, let's say, a top 10 or a top 20 index based on whether it's volume or market cap or some criteria that they've predefined. You could actually have someone set up an ICO, run a coin, get it listed on some exchange with very thin volume, control all the coins, pump the shit out of it, get the index to come in and buy it, and then dump it on everyone. That's something that I think is either probably going to happen pretty soon or it will happen definitely very soon. So that's kind of my thoughts on the ICO market in general. All right, so now we're going to talk about something called, one of the best ICOs is something called Tezos, which basically it's $250 million. They raised $250 million at the present valuation. I don't even know what that valuation would be now because when I did the math before, it was $500 million at the valuation when you're investing in either Ethereum or Bitcoin. The founders actually said that participating in the Tezos fundraiser was like contributing to a public television station and getting a tote bag in return. I still haven't got my tote bag. I don't know if y'all got your tote bag, but if you did, let me know so I can talk to someone about getting my tote bag. As far as how I go about analyzing and looking at the different coins that I do want to invest in, the ones that maybe aren't as scammy as the other ones, do some Google search analysis. I think Willy talked about that a lot. He does a really good job of that. I like to go on the Twitter and Reddit and Slack subs for these channels. Someone told me I should mention Telegram, Whale Pool, which I'll go ahead and do that. I do go on there. I like to look at the actual GitHub repository or OpenHub, see how much activity is going on there. You can actually look at the code if you're not an engineer. You can hire someone to look at it. At the very least, if you're going to invest in one of these coins that has a wallet, download the wallet, play around with the wallet. When Neo launched, when it became quite popular, I went ahead and downloaded the wallet, and I thought it was trash, but that was just me. I know Neo's quite popular. I invested in Neo. I did well in Neo. I actually sold Neo. So I think you can do actually that's in there is actually run a node. If you do this with Bitcoin, I think this is also pretty important. So if you're running a node, you can actually do a better job of analyzing the traffic that's coming through the network, which can provide you with some information that maybe you wouldn't normally have if you didn't run the node. For instance, during this last Bcash Bitcoin mania day that happened on November 12th, there was people speculating that $25 million worth of coins were moving from one wallet to another wallet, and that other wallet was the Bitfinex exchange, and people speculated that that transaction was actually Roger Vere's wallet, and so people are speculating that, okay, this is going to precipitate this big trade that's going to happen. So that's kind of how I go about analyzing the actual coins from a kind of like a quantitative standpoint, although it's not that quantitative, it's more qualitative. And I like to focus on actual event-driven trades. Everything I would talk about in terms of like methods to trade properly, I would say like no one's really talked this, but the best method you could probably have to trade profitably and do well is kind of a tried and true method. It's tough to pull off, but if you can pull it off, you'll probably make a lot of money, and that is just go ahead and acquire a ton of Bitcoin, Ethereum, and then do the publicity tour worldwide, where you go around making a prediction that Bitcoin's going to hit 10,000, Bitcoin's going to triple, there's going to be a $2 trillion valuation, Ethereum's going to 5x in a year, do CNBC, India, go on MSNBC, go on YouTube, do this, do that. I think I saw him on, I'm speaking of Mike Novogratz, of course, which I think we all owe him a debt of gratitude because the price of Bitcoin wouldn't be where it's at if it wasn't for him doing this publicity tour. I saw him on CNBC Africa, and I was like, I've never seen CNBC Africa before, but it's not bad. So I would definitely, yeah. He's basically right now the Twitter end boss, or excuse me, the crypto end boss. And so, yeah, I'm a big fan of Mike. So if you can get that, pull that off, go ahead and go for it, and I'm sure it'll be profitable for you. Okay, so some event-based things that have happened that I have actually found profitable in some ways. So early on this year, we had the China ban. For those who've been around in Bitcoin, China's banned Bitcoin like 8 or 9 times now. This time they actually did ban it. So the disproportionate reaction to this news actually created a pretty good trading event. On the one hand, you had China banning Bitcoin. It was released on like a Friday. No one really knew if it was true. The rumors might have been true. It may not have been true. The price is going down. And then you also had Jamie Dimon piling on, talking about how Bitcoin is a fraud, and he was going to fire anyone who worked for him, who actually traded in Bitcoin. So at that time that happened, the China market was quite large. I mean, when it happened, the China market was only about 10 to 20% of the overall volume of Bitcoin. Back in the day, the market was actually a lot larger. If you look at this graph here, when Bitcoin first came about in 2011, all the way up to maybe 2013, the Chinese market was a huge market relative to the US dollar market. In fact, at one point, it was almost 90% of all Bitcoins were being traded in China. So that was basically an event now where people talked about China being banned, banning Bitcoin and how this is going to be terrible. The price went down from 5,000 to 3,000. To me, that presented a good buying opportunity. It was a disproportionate reaction to the actual reality of it, which was the China market is relatively small. Which kind of leads us to a talk of bubbles and different events of some sort. I personally don't believe that Bitcoin is a bubble. If it is a bubble, it's not a bubble, it's a series of bubbles. Generally, a bubble doesn't pop and then regenerate itself 3, 4, 5 times, which Bitcoin has done. It's actually reinflated 4 times since I've been trading it, since it's been around. We're still in the very early stages of Bitcoin right now, and crypto specifically. Just to give you an idea, people talk about, and they compare it to the dot-com bubble. The US Internet Index, the Bloomberg US Internet Index, actually peaked at $2.95 trillion. Right now, we're trading at about, there's $311 billion market cap for crypto. So just compare that to the $2.95 trillion dot-com bubble, which, by the way, was only a US phenomenon. It wasn't a worldwide phenomenon. It was a US phenomenon. And you can see that I just don't really buy the idea that this is, I mean, it may be a bubble and it may have a series of bubbles that go up and down, but I don't believe that now we're in a mania that it's doomed to go down. I actually don't agree with that at all. In fact, on the peak, after the peak of the bubble, it actually dropped, I think, 1.75 trillion at its worst drop. And like I said, Bitcoin is only at 100 and some odd, 130 billion or whatever it is, and the overall market is about 311 billion. So to give you another perspective as to the size of the Bitcoin market right now, the actual gold market is $7.5 trillion. Bitcoin's at about 2.25% of that. I personally believe this. I've heard this mentioned by a few other people. BK on CNBC talks about this a lot, where if Bitcoin hits 5% of the overall gold market, we're looking at a valuation of around 25,000 a coin. I think 5% is actually low. Just from the background I have, dealing with different bankers and different investment platforms, and whether it be in Switzerland or Monaco, the amount of money that's actually invested in gold and used as a hedge for overall investing at 7.5 trillion, I don't really see any point in having your money invested in gold as a hedge when you could actually do Bitcoin. I think Bitcoin is much more efficient. You don't have to pay all this money to store it. You can move it around. So for me, I'm not really sold on the bubble thesis at all. In terms of Bitcoin, I do think that there probably is a bubble of some sorts. If you look at this right now, we're looking at the top 5 coins by market cap, which is a pretty bad way to evaluate a coin by market cap because you can't really look at the circulating supply and how many coins are actually available, et cetera. We have something called Bcash, which is $27 billion market cap. What is Bcash? I don't know. Basically, it's a Bitcoin fork. That is the true vision of Satoshi, according to their actual promoters, I guess you'd call them. Going back to an earlier slide, we talked about what are the things we're looking at. We're looking at who are the developers, right? So who are the developers of Bitcoin Cash? It seems like it's a pretty tight-knit group. It's not really that decentralized or decentralized at all. I believe they have a CEO who may or may not be someone of questionable character. I don't know. He might be actually the most honorable person in their community. I'm not quite sure. Okay, the other thing to look at is what is the actual coin governance? Well, like I said, they have a CEO. I'm not sure why this guy finds that so funny, but they do have a CEO. So, all right. So how decentralized is the mining? Not very decentralized at all. In fact, 44% of all Bitcoin Cash mining occurs from something called the unknown pool. People don't really know who that is yet, but I think everyone with a brain can figure out who it is. It's also the same guy who's building the ASIC chips. So, and then what problem is it solving, right? What problem is Bitcoin Cash, or Bcash, excuse me, I didn't mean to call it Bitcoin Cash, but Bcash solving? And I don't really think it's solving anything that a coin like Litecoin, for instance, can't solve right now. I can send Litecoin. I can send it fast. Someone can receive it. It seems to work very well. Bitcoin plus SegWit actually goes very well too. So to me, that's a pretty decent solution for it. The people who are really into Bitcoin and you're an evangelist like myself, you need to talk to all these different companies who haven't implemented SegWit yet, because Bitcoin plus SegWit will actually give you the speed and the kind of function that Bitcoin Cash or Bcash purports to have. And the last thing I'll kind of close with is the best way to destroy your investment. This is Nick Szabo. Is Bitcoin. It's to gather up an internet mob and redesign Bitcoin, which is basically what these guys have done. So That's it. That's my whole bit. Thank you so much for your time. Enjoy.